Okay, folks, welcome back, and I hope you had a decent break. So I know it's a short break, but we're now in the sprint portion of this class. We have three more to-dos on this class. The first, of course, is your third quiz that comes up next Monday. So let's get that out of the way. The second is your final project. So hopefully you've done your DCF, you're now doing your pricing, you're very close to being done. And the third is, of course, your final exam, which is 2 days after the last day of class. I think it's May 12th. And incidentally, for those of you still having questions about the final exam, it'll be structured just like the quiz. It'll be accessible for about 12 hours that day. It'll be a 2-hour exam, so you have to make sure you start in enough time to get done. But those are the three things left on the to-do list for this class. So today we're going to complete our private company valuation discussion. And if you remember last session, we talked about private to private transactions. Messy, right? Undiversified buyers, undiversified sellers, liquidity is an issue. Then we talk private to public, easy. Basically, treat it like a public company. You can use market betas, don't have to worry about liquidity. Today, we're going to talk about IPOs. You're a private company and I'm valuing you for an IPO. What would you do differently? What would you do the same as you do for any other company? So Sriram, I want to make you an investment banker and I am going to go public and I'm going to come to you for advice on what price to go public at. Because remember, the way traditional IPOs have been created is the issuing company goes to an investment bank. The investment bank sets what's called an offering price, guarantees that offering price. And on the opening trading day, the market sets a price, which could be very different from the offering price. And if the market price is lower than the guaranteed price, you have to make up the difference as the investment banker. So you're my investment banker. I come to you with the question of what are you going to price my company at? Let's say you've done an intrinsic valuation of my company. An intrinsic valuation of my company of $10 per share. I'm a social media company. And you've done a pricing of my company of $25 per share. Which of those two numbers is going to drive? You have to set an offering price at which you're going to take the company public. You're going to get 6% of the proceeds you get. So you have an incentive at least to make sure that you're not completely messing up your. So which of those two numbers would you base your pricing on? The intrinsic value or the pricing?
I might go with the pricing.
And tell me why. What's your job as a banker? What's your job?
To price things.
Yes, you're like my realtor, right? Can you imagine I have a house to sell? You're my realtor. You come in and look around my house and you say, based on my history in real estate, I've done an intrinsic valuation of your house for $500,000. And I look out of my window and I see my neighbor listing his house at 1.5 million and selling the house. You know what I'm going to do? I'm going to fire you as a realtor saying, your job was to get me the best price I can, not give me this intrinsic value grab. So a banker's job in an IPO is pricing. So $25 would be the starting point. Now remember, you're going to guarantee me an offering price. So let's say 25 is this pricing, and you think you're fairly comfortable with the pricing for my company. Is the guaranteed offering price you're going to set for me lower than the 25 or higher than the 25? Or would you set it at 25? Think about it from your perspective. What happens if you screw up? Let's say you overprice my stock. What happens? You got to make up the difference. If you underprice my stock, the deal goes through, everybody buys the shares, there's a jump in the stock price, but there's very little that you pay as a penalty. You're much more likely to underprice my shares than overprice my shares, right? Because you're going to guarantee something, you want to guarantee a lower price, not a higher price. If you go to work for an investment bank in the IPO game, this is actually very explicit. You're told to price a company. You might have to do a DCF to make it look like you did a DCF. So that's a kabuki DCF. But the pricing is what's driving it based on 10 times revenues, 25 times EBITDA. And then you're asked to put a discount on that price of about 15 to 20% before you set the offering price. Why? Because you got to build some buffer in case you screwed up. We know investment bankers systematically underprice IPOs. So who pays the penalty when an IPO is underpriced? Clearly, investors love it, right? The stock price jumps. The people who got the shares at the offering price love it. The stock price jumps. The investment bank loves it because the deal goes through smoothly. They collect 6% of the proceeds. Who's the loser in this game?
Would it be the managers or like the owners of the company going
The
public?
owners of the issuing company basically left 15% of the table, right? So I'm going to make you the founder of this company. You know the investment banker is underpricing your shares. He's been open about it. He says, look, your pricing is 20. I'm going to set it at 15 because I want this to go through well. If you're selling 100% of your ownership at the offering on the offering day, would you go along with me? Probably
No,
not, right? Because you're leaving a third of your, I mean, that's, you're saying, why would I want to give up 25% of my company because you want to get a nice, safe price? But if you are offering only 5% or 10% of your shares, or maybe 12% of your shares, and you plan to issue more shares 6 months from now, a year from now, but you're issuing only a small percentage of shares, would your answer be different? And why would you be okay with me as an investment bank underpricing your shares if you're offering only a small percentage? What do you hope to get out of that underpricing?
I mean, like you still retain majority control. So I guess.
True, but you're still losing money, right? So what do you gain? You have to get something as a benefit from the underpricing. So what's the potential benefit you might get if bankers are underpricing? What's a news story going to look like the day after the stock opens for trading? Stock jumps 30% on offering, right? Other people are reading the news story. What are the people? Usually greedy people who couldn't get in the game. Now they read the story. What do you hope they will do? That they will try to pile on now, trying to make money, and in the process, push your price up even more. That's the story that founders hope will happen when you get an underpricing. And they hope it'll last long enough that 6 months from now or 3 months from now, when you try to sell your shares, it's still up there. The worst thing that could potentially happen to you as an issuing company is you issue the shares, the offering price is 10 and it opens at 6. It's a disaster, right? Every news story is going to talk about how much of a disaster this IPO was. And when you try to sell your shares 6 months from now, that disaster might still be overhanging you. So today, what I want to do is first talk about what you might do differently when you value an IPO, then talk about how you price an IPO, and then talk about this process by which investment bankers underprice IPO, and finally talk about why the game itself, I think, is changing. For almost a century in the US, the game was if you wanted to go public, you went to an investment banker. You hired the investment banker to do the pricing. They set the offering price. On the opening day, you got this jump. And that was part of the game. People accepted it. But you're getting pushback now. And I'll talk about where the pushback is coming from and what you see as new forms for companies going public. So let me close up these slides and go back to where we were in the notes. We were talking about valuing private companies for initial public offerings. Let's talk about what it is about these companies that might make valuation a little trickier. First, you don't have any of the issues you have with private to private transactions. There's no undiversified buy. These are investors in public markets who are going to be buying your shares. There could be some control implication where the company's management might change after the offering, but at least initially it's the same people running the company. Same people running the company. The investors are going to be diversified. And if you look at the actual valuation of a company for an IPO, it looks very much like the valuation of a public company. So to give you an example, this is the valuation I did in October of 2013, October 5th of 2013, at the time of Twitter's IPO. They'd filed their prospectus. And one of the nice things about valuing companies for an IPO is the financial statements you see in a prospectus look just like the financial statements in a 10K, 10Q, or an annual report. So you're looking at the numbers that are comparable. It's very much like a public company. And I valued very much like a public company. I did exactly the way you value companies. I put a revenue growth, a margin, told a story about Twitter, came up with the value of the company. But here's the one thing that I did differently. So I'm still using a market beta, no total beta, none of those gains that you do with private to private. But one of the things I added is after you get the present value of the cash flows, you add cash. In addition to adding the traditional cash balance, I also added the proceeds that Twitter was expecting to get on the offering day. Remember, when companies go public, what they raise as cash on the offering day is called proceeds. What they plan to do with the proceeds can affect what you think of as the value of the company. In this case, that $1 billion added to the value of the company. When Alibaba went public in 2014, they raised $20 billion, $20 billion on the offering day. That added to the value instantaneously to push up the value by 20 billion. You're saying, should I always do this with the proceeds? We'll talk about when you might not do this, but in this case, that $1 billion gets added. That's really the only big difference between this and valuing any other public company. You're saying, how do you get the beta for this company? It's not public. Well, the same way I got for every other company. I did a bottom-up beta based on the business they're in. So if your betas come from bottom-up betas and you don't use regression betas, valuing a private company for an IPO is pretty simple. It's very much like valuing a public company. But here are the places where you can get some twists. From a valuation perspective, the first of the twists is what the company plans to do with the proceeds on the offering. I'm going to argue that 3 different things the company can do with the proceeds, and what you do with the proceeds will depend on which of those 3 pathways a company adopts. It can keep the cash for future investments. It can let existing owners cash out, where instead of the cash staying in the company, it goes to one of the owners cashing out, or it can be used to pay down an existing debt or financing you don't want to have anymore. And you have to tell me upfront which of those 3 choices you make. Second, when companies go public, remember these companies used to be private companies and they used to raise capital for venture capitalists. One of the things about raising capital with venture capitalists is each venture capital round creates its own equity. It's not the same class of shares. Each round you have different class of convertible preferred. So if you've gone to the venture capitalist 7 times, you can have 7 different classes of equity out there. And on top of that, you have options and warrants and all kinds of crazy stuff you've built up as a private company. Guess what? When you want to value this company for an IPO, you got to tell me what you're doing with all of that crazy stuff. In some cases, it might go away because it gets converted to shares. In some cases, it will hang in there. Warrants and options will stay on as warrants and options. You got to deal with that to come up with the value per share. From a pricing perspective, we already talked about the institutional setup, which is bankers guarantee a price, and because they guarantee the price, they want to set the price too high. There's that offering price guarantee. And the second is a question of follow-up. Not only do you need to know how much is being offered on the opening trading day, but what the owner's plans are for issuing more shares 6 months from now, a year, because how you price the offering can be affected by those choices. So let's start with what the proceeds of an offering can be used for. Incidentally, this should be specified in the prospectus. So when you look at the prospectus, if you've never read the prospectus for an IPO, pick up prospectus for a company, read through it. In the prospectus, somewhere in the prospectus, the company has to specify what they plan to do with the proceeds. And as I said, there are 3 things they can do. One is they can let existing owners cash out. That's what happened in Spotify. Spotify, when it went public, on the day of the offering, money came into the firm and left instantaneously. Why? Because owners cashed out. Existing owners decide this was their time to make their money and walk away. The second is you can use the proceeds to pay off debt that you've taken on that you don't want anymore. You're paying too high an interest rate. And the third and the most common scenario is you raise money and you keep it as cash. Why? Because you're a young, growing company. You need this cash to cover future investments. This now becomes part of your cash balance. If the money is taken out of the firm, you can ignore it because it's money coming in through one door, leaves out. You can act like it's not even there. If it's money used to pay down debt, it should show up as a different debt ratio, a different cost of capital, show up in your discount rate. But if it's money that's kept in the firm, that's like an increase in your cash balance. You got to add it on to your existing value, saying my value went up by $1 billion because I raised $1 billion from my offer. So if you look at the Twitter IPO, in the prospectus, they were very clear about what they planned to do. First, they weren't clear about how much money they planned to raise in the offering. And here I had to read what was rumored. And usually the rumors are pretty close to the truth about how much the company plans to raise. And the rumors said they were planning to raise about $1 billion on the offering day. So that was the proceeds. And in the prospectus itself, they said they plan to hold the cash in the company as a cash balance. So guess what I did? I did my discounted cash flow valuation, added the $1 billion in cash, saying it's going to stay in the company. So the proceeds, the easiest way to deal with them is check the prospectus, see what's going to be done with them, add it onto the value. Second stop, check those claims from from previous investors, VC rounds, what's left over. The residue of all of that capital raise will show up as multiple class of shares, options, warrants. You got to clean up the mess when you try to decide what the value per share will be in the offering. And I'll be quite honest, bankers are terrible at clearing up these messes. In most prospectuses, you'll see the company list out what they claim will be the number of shares outstanding in the company after it goes public. And then they'll say, but this count does not include 1, 2, 3, like 15. And you say, why? What happened to these shares? In the case of Twitter, here's what the prospectus said. They had 7 classes of convertible preferred shares. Why 7 classes? Because they had 7 VC rounds. Each VC round brought in a different class of convertible preferred. But my life got simple because they also said that on the day of the offering, these convertible preferred shares would be instantaneously converted to common shares. So guess what I did? I took those 7 classes of shares, added them onto my common shares. They also had 86 million restricted stock units. Remember we talked about this as employee compensation? Twitter itself claimed that they weren't going to count the 86 million as part of the share count. And I said, no, I'm going to count it. It's shares outstanding. So I counted the 86 million restricted stock units as part of the shares outstanding today. They also had 44 million employee options. And they gave a strike price and a maturity. I valued those options as options using an option pricing model, came up with a value of 805 million. Here's the bottom line. The number of shares I used included the restricted share units and the convertible preferred shares converting into shares. The value of the options showed up in my valuation. If you look at my DCF valuation, you'll see me subtracting out 805 million. That's the value of the options from VCs being netted out. I've essentially cleaned up for claims from prior equity investors. So when you're looking at an IPO of a young company, especially if it's a tech company, check the share count. It's amazing how badly services like Yahoo and even analysts do in terms of counting the shares that are outstanding in the company. And finally, there is the investment banking guarantee. Until about 5 years ago, almost every IPO that was done went through an investment banker. The investment banker offered services. What are the services you get from an investment banker if you're a young company? First, the investment banker adds credibility, right? Nobody's seen who you are as a company. Goldman Sachs takes you public. They say if Goldman Sachs takes you public, you must be a credible company. Second, the investment banker prices your company. What do they base the pricing on? Well, they actually can get feedback, right? They can call portfolio managers and say, what would you pay for the company? And if it doesn't look like it'll fly, they can change the price. There's a pricing. And finally, there's also selling. They have these road shows. Have you heard of what road show is? Basically, they go around the country describing the company and trying to get investors, interest in the company. So for about a century now in the US, that's how IPOs have been done. And because investment banks give this guaranteed price, they also tend to underprice IPOs. They knock them down by 10, 15%. So if you look at what happens on the offering day, you usually get that. But it's a pricing game. It's not a valuation game, it's a pricing game. So after I valued Twitter and came up with $18 per share, I said, why am I valuing the company? If I'm going to take it public as a banker, I want to price the stock. I don't know whether you remember, but when we did pricing, I looked at social media companies at the time of Twitter's public offering. And what did we discover? We discovered that social media companies were being priced on a metric. What was the metric? It wasn't revenues, it wasn't EBITDA, it wasn't net income, it was number of users. And it turned out that the market was paying roughly $100 per user. Do you know what I did? I took the number of users, Twitter had 215 million users, multiplied it by $100 per user, come up with 21.5 billion. There's my pricing for the stock. If I'm a banker, that's what's driving what I'm going to ask for the stock. But as I said, even if you're a banker who believes your pricing, you're going to underprice the stock because you don't want to overprice. And there is evidence that if you look at what happens on the offering day, there is evidence of this underpricing. So this is actually from studies that look at what happens on the first day of trading to the stock price. Think about it. If bankers set the price roughly right, what should happen on the opening day? Roughly nothing. Some stocks might go up, some. But if you look across all IPOs, here's what you discover. On average, IPOs are underpriced by about 15, 16, maybe even 20%. Smaller IPOs tend to be underpriced more, but there's a clear underpricing across the board. Bankers do it systematically. But this raises an interesting follow-up question, which is, if we know bankers do this, they underprice IPOs, is there a way we can make money of this systematic behavior? What do you think, Sebastian? Is there a way I can take advantage of bankers underpricing IPOs? What could I do?
I mean, you'd have to get in on that IPO.
Offering price. First, you'd have to get in at the offering price. But if I was able to get in every IPO at the offering price, clearly this is going to make me a lot of money, right? At 15% underpricing is going to be like bonus on every investment. You know what? For 40 years, there have been people who've tried to do this. But there's one fatal flaw in this strategy. Just, I'm going to come back to Sebastian and ask, what do you think the biggest problem is with implementing this strategy? So let's say you decide to start a fund and you're open about this. On every IPO, I'm going to apply for 1 million shares. What's a fatal
I feel like you probably have to pay a premium maybe to be able to actually get those shares, or is there some price?
Not necessarily, right? You apply for these shares, but you're applying at the offering price, but you won't get all the shares you ask for. There'll be rationing, because if there's too much demand for an IPO, you ask for 1 million shares, you might get only 300,000 shares. And therein lies a problem. When those IPOs that are most underpriced, you're going to get very few shares. On those IPOs that are pretty close to fairly priced, you might get 700 or 800,000 shares. And those IPOs that are overpriced, where they screw up like that 15 or 20% of the time, you get every single share you ask for. So you know what a mutual fund is going to look like, right? It's going to be overweighted in all the bad IPOs and underweighted in the good IPOs, because you don't get shares in every single IPO. You get shares based on the pricing of the IPO. And that's been the biggest challenge in terms of trying to take advantage of this mispricing. We know it happens. It's not easy to make money off it. You're saying, what if I were a preferred client of an investment bank? And some preferred clients get that first dibs, right? I remember when Roy Smith used to teach at Stern. He used to be a Goldman Sachs partner and a managing partner high up in the ranks. And of course, he taught at Stern. When I think Facebook went public, he got a call from his from Goldman Sachs saying, would you like to get 1,000 shares at the offering price, or 10,000 shares? But usually when you're a preferred client, it also comes with catches, which is you're not allowed to sell the shares for 3 months or 6 months after you buy the shares. So the kind of shackles they put on you might mean that you can't make the money that you thought you would. So all I'm saying is not that you cannot make money of this mispricing, but that it's a lot more difficult than it looks because of the difficulty of locking in the shares at the offering price. As I said, for a century, this has been the way IPOs have been priced. Bankers set an offering price, the price jumps 15%, and both the issuing company and banks were okay with the status quo until two things started happening. One was you started seeing the price jump 50%, 100% on the offering day. That's kind of a breaking of the pact, right? This is not just underpricing, it's screwing up big time. And in some cases, the bankers were getting the pricing so wrong that he said, well, why am I even paying a banker to do this to me, do this for me and to me, when I could pretty much go to the market directly? So about 3 years ago, Bill Gurley, and he's been doing this for a longer time, but about 3 years ago, he got really vocal about it. Bill Gurley's a leading venture capitalist. He was in the Uber IPO, Benchmark Capital. He said, why are we paying bankers to set offering prices when they seem to have no idea what they're doing? Their pricing is awful. Their selling really doesn't make sense. He said, why don't we just go directly to the market and list? You're saying, how does that work? You're a company, you want to go public, you set the offering day, and the way the price is set is by demand and supply on that day. Basically, you do everything you do with a traditional IPO. You file a prospectus, you reveal everything about yourself. But rather than letting a banker set that intermediate offering price, you skip that step and you let the market set with demand and supply what the price should be. It's called a direct listing. And you say, what do I lose? You lose the credibility supposedly the banker would give you. But let's face it, if you're Airbnb, do you really need a banker to tell the world who you are? Everybody knows who Airbnb is. In fact, my guess is more people have heard of Airbnb than have heard of the bankers taking Airbnb public. So Bill Gurley's argument is maybe it's time to move on to direct listings where we skip this banking step. Of course, bankers don't like this idea very much, but you can see where it's coming from. But there are limits to direct listings. One of the limits of a direct listing is when you do a direct listing, and this is an SEC requirement that might be changed in the future. If you do a direct listing right now, the proceeds you get from that listing have to be cashed out by owners. Remember the three choices I gave you, where you could keep it in the firm or use it to pay down debt? If you do a direct listing, you have to let owners cash out. Spotify did a direct listing. Because they did a direct listing, they could not raise capital on the offering day. The money had to go out. And because they needed money, they had to make a secondary offering a few months later to raise the money. But that door is now open. If you're a high-profile company like Airbnb, and you ask me, I'd say skip the banking step. They have no idea what they're doing. Their pricing is crappy. Their selling doesn't do much. Just go directly to the market. If you're a really small company, nobody's heard of you, then maybe you still need the banker to kind of get people to understand who you are. But the need for bankers has dropped off. So when you think about, about that underpricing, clearly companies are hurt by it. But if you're selling only 10 or 15 or 20% of your shares, you could see why companies were willing to go along. They said, it's okay. If I'm underpriced by just 15%, what's the big deal? I'm selling only 10% of my shares. The bulk of the shares are not going to come out for 6 months or a year. So this pact between banks and issuing companies held as long as bankers did a reasonable job of pricing the company and a reasonable job of selling the company and adding credibility to its name. So now you're starting to see some companies go public with direct listings. For instance, Coinbase is a direct listing. That's why people had no idea what the market price was going to be. There was no offering price. Coinbase was a direct listing. It went directly to the market at $85 billion. And why did Coinbase do it? Well, because Coinbase, people know what Coinbase does. They don't need an investment bank saying, investment banks probably don't even understand Coinbase to try to describe it. So one alternative to the traditional IPO has become a direct listing. There's another alternative that's popped up, especially in the last year. What's that alternative? What's a third choice for a company that wants to grab, is trying to, and WeWork, the kind of WeWork part two? What's the third option for a private company that wants to go public? Louis?
Would it be a SPAC?
A SPAC. So tell me what's different about a SPAC. Let's suppose you're Grab, you want to go public. How would this work?
Would you find a SPAC that's already, you try to partner with a SPAC that's already been set up and traded?
So the SPAC has to be created, right? So somebody creates a SPAC. Usually there's a founder with a name. It could be Chamath Palihapitiya. It could be Vivek Ranadive, who's the owner of the Sacramento Kings. They create a SPAC and they take it public. The minute after SPAC goes public, here's what it looks like. It has shares outstanding and all the money is held in cash. You're saying, why would I invest in a company that has no business? The SPAC is very specific. It says, look, within the next 2 years, and SPACs always come with a time limit, we plan to do an acquisition. And they usually name the acquisition. In the case of Vivek, he's actually named WeWork as the company they plan to acquire. So WeWork, instead of trying to go public the traditional route, and you can see why WeWork doesn't want to go the traditional route, right? They tried it once, it blew up big time in their faces. They're letting a publicly traded company acquire. You say, what do I gain as an investor? What you're hoping for is that Chamath or Vivek will now negotiate on your behalf and get a much better price for you as an investor than they could have got if they bought the shares in the first place. In return, they take 20% of your money. So this is not a free lunch. And you also hope that they will find the right target, that they're targeting the right company taken public. In other words, you're trusting somebody because of their name to go out and find a good private company for you to buy at a low price. And in return, you're giving up 20% of your money. Do I think it's a good idea? I think it's a terrible idea. I think it's a terrible idea because you're trusting somebody to do an acquisition of a private company in the next 2 years and do everything right and get the right price when they've already collected their money. What incentive do they have to negotiate for the best price for you? They've got 20% of your money already from the SPAC. But SPACs have become, I think, the third way in which, so if you want to kind of draw this contrast, so traditional IPOs, you have the issuing company, you have a banker as an intermediary, and then you have the market. Direct listing, you skip the bank, you go directly to the market. With a SPAC, you create this mechanism that is a SPAC, and you let the founder of the SPAC kind of negotiate on your behalf to get the best price you can on the private company. At the end of the game, you're still going to get the same end result. The company is now public, but how it got public was different with the three pathways. Somebody had a question I kind of skipped over. No.
Yeah, Professor, I had a
Go ahead.
question about the direct listing in particular with the pricing. Like, how does if a company's going to the market via direct listing, how do they price their stock?
They don't, right? It's demand and supply. So what they do is they describe the company, they file the prospectus, and then they throw it out to investors. On the opening, on the first trading day, what happens is you get buy orders come in based on what people have seen in the prospectus. And people, you can give them some clues. On the last venture capital round, we were priced at 50 billion, 60 billion. That's what Coinbase did. So they started throwing these numbers based on the last VC round, but that's what you'd have got with an investment banker as well. So the pricing is actually done in the market on that first trading day. That's why there's a lot more uncertainty about the price, but at least you're not leaving money on the table. You get whatever price it is, you get it, so there's no offering price which is set way below that number or way above that number. So that all you're skipping is this offering price step, right? Because the offering price is not even a price. It's kind of a price the banker set, but nobody cares about it because on the first trading day, it's demand and supply that sets the price. So all you've done is skip that step where the banker sets an offering price. But it kind of cuts to a much bigger issue, right? I think 2008 did real damage to this process. Here's why. This notion that banks add credibility to companies is now gone, right? 2008 kind of removed the credibility of banks. And since 2008, the pricing screw-ups you've seen on IPOs have been so large that you say, why the heck would I pay these guys money to set my pricing when they get it so wrong? So I think that this is a process you're going to see continue because I think the traditional IPO banking model is broken. It doesn't mean it'll go away. There'll be a subset of companies that will still use it. But I think you're going to see direct listings. SPACs might not be here to stay, but I think you're going to see more creative ways in which companies go public because it's much easier now to get information to investors. You don't need road shows. You don't need a banker as an intermediary said, let me tell you how I price the stock. And the less we need bankers, the more we're going to see these alternative mechanisms built up. Raja?
Yeah, I'm curious as to how this affects the position of the investor when we are investing in a new company that's going IPO via a SPAC or by its own listing. We have no kind of information as to where the company might fall and creates.
No, you have exactly the same information the banker had, right? You have the same prospectus. How did the banker price these stocks? What's
yeah,
the
but
magic?
the
What
banker
did they do? They did peer group analysis. They did what you're doing on your stock now. They compared the PE ratio, EV to EBITDA, EV to sales. I mean, is this rocket science? I mean, you priced your stock. Why would you need to pay a banker $60 million to do something that took you 2 hours to do with Capital IQ?
So for the uneducated investor masses who don't, understand valuation,
It's a
and they have to
very
kind of-
elitist view, right? I mean, it's in a sense, how educated are we? I mean, I'm not sure there's anything we're doing that somebody who has a high school education wouldn't be able to do.
True.
And that's part of the problem is we think that somehow we're above the masses. Hey, remember, masses basically bring in the collective wisdom of the mass is going to be far greater than any one of our individual wisdom. So, and that's part of the problem here. The SEC has historically taken this very paternalistic view about investors. And their view is investors need to be protected from their own screw-ups. And guess who's going to protect them? Goldman Sachs and Morgan Stanley and JP Morgan. Come on. JP Morgan and Goldman Sachs and Morgan Stanley are going to protect me? I mean, after the last 12 years, do you really think banks are out there to protect you? I don't think so. And I think this goes back to that loss of faith in bankers being these more credible intermediaries. And you're going to start to see this play out in not just IPOs, but in almost every aspect of corporate finance where bankers are intermediaries. You know what the most informative number in the market is? It's whatever the market price is. That's set by demand and supply. You let the market open. There's more information in that first trade that you will get on that opening day than anything else done in this company over its, by bankers, by consultants, by appraisers, by analysts.
It levels the playing field in a sense, is what you're saying too.
It levels the playing field and it takes away an intermediary who's adding nothing to the playing field, right? I mean, that's the question is what, if I were looking at bankers and said, tell me what you're bringing to the table. Why am I paying you $60 million? It's not the selling anymore. It's not the pricing. It's not the credibility. So what the heck is it? Why am I paying that money? And once you decide that an intermediary is not worth it, you just take them out of the picture and saying, okay, might as well skip the intermediary, go directly to the market. Which brings me to my final scenario. So we talked private to private, private to public, private to IPO. Let's talk about a private company that right now is owned entirely by its owner, who's undiversified. Why? Because they can't afford to be diversified. That's a founder owns it. But the way the company is going, it expects to raise capital from venture capitalists 2 years from now and go public in 5 years. And you've been called in to value the company. So right now it's a private company. The owner is undiversified. Because the owner is undiversified, you say, look, the beta that I'm going to use is a total beta, reflecting the fact that only 25% of the risk in this company is market risk. So I use a total beta. Beta 4 gives me a cost of equity of 24%. So for the next 2 years, I use a total beta, I use a cost of equity of 24%. At the end of 2 years, my marginal investor shifts to becoming a venture capitalist partially diversified. Where does it show up? The correlation is not 1, it's 0.5. So it goes from 0.25 to 0.5. That's a more diversified investor. My beta then will become 2 because the investor who is now coming into the company is a little more diversified than the original owner. 5 years from now, the company goes public, the beta goes to a market beta 1, the cost of equity becomes 9%. This is a company where the cost of equity is going to be 24% in the first 2 years, 14% in the next 3, and then it's going to be 9% thereafter. Not because the company is getting safer, but because the investors in the company are shifting from a completely undiversified to a partially diversified to a fully diversified investor. So how is this going to play out in evaluation? Let's say I have to value this company and I've projected out cash flows. So those are my expected cash flows. Beyond year 5, let's assume I become a mature company and I have a cash flow 175 going on forever. Here's what I do. To get my terminal value, I use my 9% cost of equity. That's the initial public offering. But to get to that terminal year, I've got to live through a lot more risk. So the way this shows up then is my cost of equity is 24% for the first 2 years, 14% for the next 3, and 9% thereafter. Remember we talked about cumulated discount rates. If your discount rate changes over time, you got to remember to accumulate the discount rate. The cumulated cost of equity reflects that cumulated discount rate. What I get is a value for the firm if I use the right discount rate here, which is 24% for the first 2, 14% for the next 3, 9% thereafter, is about 1.5 million. If I decide to use the 24% cost of equity as my cost of equity all the way through, I'm being unfair to the company because this company is not going to stay owned by a completely undiversified investor forever, much lower number. And if I decide to use a market cost of equity, I'm overestimating value because I'm missing the risk I faced before I become a publicly traded company. So it's an extension of a principle we had in DCF. You're not stuck with one discount rate. Your discount rates can and should change over time. But the implication of what I've done in this page is if you have a company, a private business, which you expect will go public or get sold to a public company, that private business should be worth more than a private business that doesn't have the choice. So if you have an AI company or a technology company, given that AI technology companies are likely to be acquired by other public companies or go public, I'm going to attach a much higher value to that company than a privately owned grocery store where you say, look, I can never go public. Second, the sooner you can shift from private to public, the more valuable you become as a company. Take that previous valuation. If you'd been able to go public in 2 years rather than 5 years, think of how much more your value would have been. And here's one thing that has changed in private companies that has made them more valuable. In the old days, here's how the transition worked. You're a founder-owned company, and then your VCs owned the company, and then you went into the public market. VCs were partially diversified, founders were undiversified, the public market was diversified. What's happened, especially over the last 10 or 15 years, is now a public market investors, people like Fidelity and T. Rowe Price, that are investing in private companies while they're private. Uber got investments from, you see how this helps you as a private company? Because now, if I know that your marginal investors are going to become Fidelity and T. Rowe Price by the time you get to year 3, I don't have to wait till year 5. I can shift from a 24% cost of equity to a 9% cost of equity much more quickly. When you see private company valuations, remember, private company valuations are tied at the hip to public company valuations. Right now, Silicon Valley is doing really well. A lot of private companies are seeing the values go up. You know why they're going up? Because public company valuations are going up. If the public market corrected by 40%, you should expect to see private company valuations almost instantaneously correct as well, because they're not two separate markets. They're linked because the private companies are being valued on the potential that they could become public companies. So let's summarize what we've learned in valuing private companies. The value of a private company will depend on who the potential buyer is. I cannot value a private company without knowing who you plan to sell it to. And your value is going to be greatest if you sell to somebody who's a long-term investor, who's well-diversified, who doesn't care about liquidity. You see why? If you're well diversified, I can use a market beta. You don't care about liquidity. I don't care about the illiquidity discount. So one reason. The best potential buyer for a private business is often a public company or a diversified investor, not another private individual. As a final proposition, if you're owner of a private company, remember you always have a choice. You might not like to use the choice. The choice is you can get rid of this position of the private company and hold publicly traded stocks. You might love running a private business, but your money has an alternative use. That's what your cost of equity is trying to capture, is what that alternative use could deliver to you. Any questions on valuing private companies? Okay, so let's turn to the third packet. If you don't have it, don't worry, because today we're just going to lay the groundwork. So far, much of what we've talked about is timeless. People have been doing intrinsic valuation for 600 years, pricing for 600 years. As long as people have been buying and selling businesses, they might not have used a cost of capital based on a CAPM, but they used risk-adjusted discount rates. They price things based on what other people are paying. What I want to talk about next in this class is perhaps the only area in valuation where new and different things are being done. And that is especially in the context of what's called real options. Now, when we talk about real options, we're talking about things like delaying an investment where you have, so let's say you have the exclusive rights to a technology or an investment. You have the right to delay or defer. You don't have to take the investment right now. So that's an option. If you're a company with excess capacity, you have the right to increase or reduce capacity. That's an option. You have a company that takes a project that gives you the right to do other things. That's an option. Real options refer to things that companies do, as opposed to listed options. You buy call options in IBM. In a real option, you're talking about an undeveloped oil reserve, you're talking about a patent, you're talking about a technology. But underlying all of this is a simple reason why real options are so attractive to consultants, to bankers, to companies. You know what real options allow you to do? They allow you to pay a premium over and above your discounted cash flow value. Remember we said discounted cash flow value is what you should be willing to pay as a company. That's how much a company is worth to you. When you make a real options argument, you're arguing that you should pay a premium on top of that DCF. And you're not doing it because you're crazy or irrational, but because there's an optionality in the company. Just to give you a sense of how much real options have exploded. I've been teaching real options in my class since the 1990s. When I first started teaching real options, I couldn't find a single paper or a single book on real options. Today, every consulting firm, every investment bank has a real options team that walks around trying to attach real options to everything you do. So I'm going to give you a very simple basis for understanding what the allure of real options is. What is it that drives the value of a real option? And to do this, I'm going to use a very simple decision tree. So Jake, you're going to help me here. Let's assume I come to you with a gamble. There's a 50% chance of success and a 50% chance of failure. If you succeed, you're going to make 100 million. If you fail, you're going to lose 120 million. What's the expected value of this gamble to you?
Negative 10 million.
Negative 10 million, right? So that was a no-brainer. Don't take the investment. Now I'm going to play a little game. I'm going to take this investment I showed you and break it up into a slightly different version of the same investment. Now you have two branches, a mini investment up front, but there's a 75% chance of success where you make 20 million and a 25% chance that you lose 20 million. If you lose 20 million in that first round, you stop. The game's over. But if you make 20 million, you continue with the second investment. But there's a 2/3 chance of making 80 million and a 1/3 chance of losing 100 million. Think of your collective losses, 120 million, your collective gains, 100 million. There's a 50% chance of your collective gains and roughly speaking, a 50% chance of failure. So it looks very much like the first investment, right? 50-50 shot plus 100 money. You know what the magic is? If you take the expected value of the second decision tree, it's actually positive. This is like magic. I took a decision tree that had negative payoff, and by just tweaking it, I made it into a positive value investment. So here's my follow-up question. What is it about the second investment that makes it more attractive than what's it about the second decision tree that gives you an advantage as an investor over the first one? Jake, I'm going to stay with you. What is it that the second tree gives you that you didn't have in the first one?
You have the options like wait till a future date to decide if you want to invest more capital.
In other words, you get a small shot up front, like a market test, right? If the market test works, you keep going. If the market test doesn't, you don't. There are two things in this second decision tree that are the foundation of real options. The first is learning. That first tree gives you some learning. You learn something about the project. And the second is you change the way you behave based on what you've learned, which is if you get a positive outcome, you keep going. If you get a negative outcome, you stop. Learning and adaptive behavior are at the core of real options. I'll give you a very simple real-world example. Think of how we value oil companies. We have an oil price. Remember we talked about being oil price neutral. We project out the expected cash flows based on expected production, and we discount that back at a risk-adjusted discount rate. You know what we're missing when we value an oil company based on expected production times expected oil price? As the managers of the oil company, you're not locked into production, right? What do you get to observe before you decide how much to produce? You get to observe the oil price. Let's say the oil price is $25 a barrel. It's horrifically low. You know what you do? You say, look, I'm not going to produce much oil. I'm going to produce 20,000 barrels of oil. If the oil price is $75, you say, I'm going to produce 200,000 barrels of oil. The learning comes from observing the oil price. The adaptive behavior comes from you adjusting production to reflect what you've learned. To cut a long story short, I think traditional discounted cash flow valuations undervalue commodity companies. Why do they undervalue commodity companies? Because they're based on expected production times expected price. They're missing this optionality. We'll talk about how to attach that premium, but you can see where the premium is coming from. It's from observing the oil price and adjusting production. So as we go through these real option examples, that's what you're looking for. Where's the learning and what am I changing in my behavior based on that learning? So I'm going to lay the foundations for how to think about real options. Because here's my concern. Right now, real options are this, remember we talked about weapons of mass distraction, where people throw buzzwords at you and expect you to pay a premium. We'd call control premiums, brand name premium, ESG premium. There's a real option premium. People pay a premium. There's a real option there. People have become lazy. So I'm going to give you the 3 questions that you and I need to ask before we decide to attach a premium because we think there's a real option. Here's the first question. When should we even be talking about an option? So I'm going to start by saying, is there an option? Because 9 times out of 10, people mistake opportunities for options. The fact that you're in a big market doesn't give you any optionality. We're going to talk about what it is that creates an option. Second stop, when does that option have significant economic value? Because otherwise, why waste our time trying to value it? Third, when can I use an option pricing model to value this option? And here's what you're going to see. For every 100 opportunities that people present as options, maybe 10 out of the 100 are really options. Out of the 10, maybe 2 out of the 10 have value. And maybe 1 out of the 2 can be valued using an option pricing model. So out of every 100 times you're presented with a real options argument, 1 time out of 100, you get to use an option pricing model. Option pricing models should not be brought out unless you absolutely need them. Because when you bring them out to kill, it's like bringing out a shotgun to kill an ant. It's mass. I mean, this is high-powered ammunition. You don't need it unless you absolutely need it. Bring it in. So let's start with the first question. How do we know whether there's an option embedded in an action? Let's step back. Let's think about what an option gives you. Remember your first finance class? An option gives you a right. First word is right. Not an obligation, but a right to buy or sell something at a fixed price, right? A call option gives you the right to buy something at a fixed price. A put option gives you the right to sell at a fixed price, and you have a finite period, 3 months, 6 months, a year to exercise this right. So for something to be an option, there has to be an underlying asset. An option cannot live on its own. So when somebody says, I have a real option, my first question is, what's the underlying asset? And they can't answer, I'm walking away. So there has to be an underlying asset. And the payoff has to be contingent on something happening. Like what? S gets greater than K. The value of oil exceeds the cost of the oil you have in the reserve. And the best way to see if there's an option is to think in terms of payoff diagrams. Payoff diagrams you can draw for any asset, but the payoff diagram for an option is unique. And here's why it's unique. It comes with a kink around the strike price. With a call option, if the stock price is less than the strike price, the most you can lose is what you pay for the option. It's got limited losses, but it's got potentially unlimited profits. With a put option, you have limited losses, the stock price exceeds the strike price, and potentially very high profits if the stock price drops. One of the things you're going to see me do is whenever I talk about a real option, whether it's a patent, whether it's an option to expand, I'm going to draw a payoff diagram, and it's got to look something like this. Otherwise, I can't talk about options. Is there a kink in the payoff diagram? What's the underlying asset? So that's the first step. Don't talk about options unless you have this kind of payoff diagram. Which brings me to the second question. When does an option have significant economic value? For options to have value, they have to have exclusivity. You know what I mean by exclusivity? You and only you have to be able to exercise the option at that. If everybody has the right to do something, you don't have an option. Everybody can do it. Now, and we're going to talk about in the context of real options, do you have exclusivity? When you have undeveloped oil reserves, where do you get your exclusivity? There's only so much oil under the ground. Just because oil prices go to $300 a barrel doesn't mean I can go dig in my backyard saying, I'll look for, you can look for oil as much as you want, but the exclusivity there comes from a natural scarcity. When you have a patent, where do you get your exclusivity? Because the law protects you from competition, right? So your patent might be more useful and valuable if it is in the US and you can enforce the patent than it is in another country, and I won't name countries, where you have a patent but nobody enforces the law, in which case there is no option there. Anybody can take your patent and run with it and nobody's going to protect you. Is there exclusivity? To me, this is the magic word that will get rid of 9 out of 10 people pestering you about real options. Say, where's the exclusivity? Because if there is exclusivity, then we're talking about something that has meaning. And then you can talk about what is it that drives the value of that option. And you know what? We know what the 6 variables that drive the value of an option are. There are only 6. 3 relate to the underlying asset. The first is the value of the underlying asset. As that goes up and down, the right to buy or sell that asset is a fixed price. It's also going to be affected. If you have a call option on a stock and the stock price goes up, guess what? Your call option will also go up. And your put options will go down. Value of the underlying stock. The second is the greater the variance in that value of the underlying stock, the more valuable all options become, calls and puts. Risk is your ally when it comes to options because you have limited losses. And the third variable is kind of obscure, but might as well state it. If you have an underlying asset that pays a dividend and you own call options, you should worry. You know why? When a stock pays a dividend on the ex-dividend day, what happens to the stock price? So let's say you have a $20 stock, it pays a $1 dividend. What should happen on the ex-dividend day? Joe, you want to try?
To me, if the company is paying a dividend on a certain day, I don't know why that would affect the price of the stock.
If it didn't, you have a magic machine, right? Because then what would you do? You'd buy the shares the day before the dividend is going to be paid, hold the share, collect the dividend. It'd be like a money machine, right? So you know why it doesn't work is the day the dividend gets paid, cash leaves the company. Remember that cash was in the company, you were valuing it as part of the company. Your share price drops by roughly the amount of the dividend. And if you're a shareholder of the company, you're not worse off because you get $1 in your pocket. Your share is now worth $19 instead of $20. But overall, you're still where you were. But if you own a call option on the stock with a strike price of 20, you can see why this hurts you, right? Because you don't get the dividend. The stock price has gone from 20 to 19. Your call option is worth less. The more dividends your underlying stock is expected to pay, the less valuable call options will become on that stock, and the more valuable put options will become. Those are the 3 variables relating to the underlying asset. There are 2 variables relating to the option. One is the strike price, right? The right to buy something at a fixed price is worth more if you have a lower strike price rather than a higher strike price. So call options become more valuable at lower strike prices. Put options become less valuable. And the other is how much time you have to play the game. The longer the time on an option, the more valuable options get. Joe?
So wouldn't the law of no arbitrage make it so that the price wouldn't be affected because those dividends are expected?
No, the law of no arbitrage is what makes sure the price gets affected. Because if the price did not get affected, you would have arbitrage, right? Because all you're doing to do is buy stocks cum dividend the day before the dividend is paid. If the price never changes, you collect the dividend. The price is going to be roughly what it was the previous day, and you're going to walk away with $1 in your pocket. The only way I can stop you from making easy money is the price drops by roughly the amount of the dividend, so you're no better off or worse off, but buying before the ex-dividend day. So it's precisely to prevent arbitrage, the price has to drop. Jacob?
Okay, thank you.
Hi, Professor. I was wondering, in the situations that we talked about where like a company does not use its cash effectively at like below its cost of capital, and thus the cash is valued at less than $1 when it's inside the firm, and that if you could pay it out,
the
then
price
that cash would be better.
might drop. Yeah, the price might drop by less than the cash balance then, right? Because you have a discount on the cash, the fact that they paid the cash, but that's going to happen when they announce the dividend, not when the ex-dividend. By the time you get to the ex-dividend day, there's no news left, right? This was announced 4 weeks ago. So if you are relieved that this company is returning the cash, the day that that relief will show up is the day when they announce they're going to pay the dividend, which is 4 to 6 weeks ago. You've now come to the ex-dividend day. By the ex-dividend, there's no suspense left. All that's happening is ownership of the dividend is passing hands. So on the ex-dividend day, there's no news story. It's just basically the dividend effect.
That makes sense. Thank you.
Okay. And the only macro variable that drives option prices is the level of interest rates. And here's why it matters. Remember the call option, you get the right to buy something at a fixed price 2 years from now. If interest rates are 15%, the present value of what you have to pay becomes much lower, right? So even if you've agreed to pay $1 million for an apartment, if interest rates are 15%, you can set aside $700,000 today. You'll have $1 million. So the value of call options become more valuable when interest rates are high. Right? Because you pay the present value of what you have to pay becomes much lower. And the value of put options becomes much lower when interest rates are high, because what you will receive is worth a lot less. That's the only macro variable that affects options. So let's think about option pricing models. When you think about option pricing models, it's worth remembering that every option pricing model is built on two foundational principles. The first is the notion of a replicating portfolio. Sounds fancy, but a replicating portfolio is created by combining the underlying asset and borrowing and lending to create something that looks exactly like your option in terms of cash flows. That's what's replicating. The second is the notion of arbitrage. As Joe pointed out, arbitrage means you can't make riskless profits. So if you have two investments with the same cash flows, one is the option, the other is the replicating portfolio, they have the same cash flows, they have to be valued at the same number. Every single option pricing model is built on the process of replicating portfolios and arbitrage. But to create a replicating portfolio, here's what you need to be able to do. You need to be able to buy and sell the underlying asset. You need to be able to buy and sell the option. You need to be able to borrow and lend at the riskless rate. Now, the borrow and lend at the riskless rate, let's cut some slack. Every model assumes it. It's impossible to get to, but you can get close enough. But let's take the first two. If I buy a call option on IBM, the traded stock, I can buy and sell the underlying stock. I can buy and sell the option. Clearly, replication works. I can use an option pricing model. But if I'm using an option pricing model to value a patent on a drug, you know what the underlying asset is? It's the cash flows I would get if I developed the drug today. That's not traded. I don't have a price for it. The patent is not traded. I can't get a price for it. It becomes much more difficult for me to do replication when I have an option where neither the underlying asset nor the option gets traded. Does that mean I cannot use an option pricing model? I can, but it doesn't have the same power because I can't cash out. I can't monetize the model. You know what? 90% of real options suffer from this problem. Neither the underlying asset nor the option is traded. We use option pricing models to value these real options nevertheless. But you need to have that caution that this might not be as easily converted to real money. So let's talk about the process of creating a replicating portfolio. To create something that looks like a call option, here's what I need to do. I need to borrow money and buy shares in the underlying stock. You're saying, how much do I borrow? How much do I need to buy? That's what the option pricing model will give you the answer to. You buy $50 and buy 0.8 shares of stock. You've created something equivalent to a call option. With a put option, I've got to be able to sell short on the underlying stock and invest that money in something riskless. You give me a call or a put option, I should be able to create a replicating portfolio. And once I create the replicating portfolio, in effect, I've valued the option, because you can tell me how much it costs you to create the replicating portfolio. And because of arbitrage, that's exactly the same price as the option. the best way to see replication arbitrage play out is with what's called the binomial option pricing model. So let's step back. Let's suppose you have a stock that right now is trading at $50 per share. Let's say you have a 2-period model, basically time 1, time 2. And in a binomial model, at any point in time, you can jump to only 1 or 2 points. So if your stock price is today 50, at the end of the first time period, the stock price can either be 70 or 35. At t equal to 2, the 70 can become 100 or 50. If it goes to 35, at t equal to 2, it can go to 50 or 25. So this is a stock that right now is 50, but 2 periods from now, it can be anywhere from 25 to 100. I offer you a call option on the stock with a strike price of 40. Let me pause right there. If you exercise this option right now, you could buy the shares at 40, sell it at 50, you'd make $10, right? But if you let it ride, you have 2 more periods. Let's look at what will happen. If you have a call option with a strike price of 40 and you let it ride for 2 time periods, that's what the option maturity is. At the end of t equal to 2, let's see what the option is going to be worth. If the stock goes to 100, the cash flow on your call is going to be 60. You see why it's going to be 60? You're going to buy the stock at 40, sell it at 100, keep the difference. If the stock goes to 50, you're going to buy it at 40, sell it at 50, you're going to keep 10. If the stock goes to 25, why isn't it minus 15? Rebecca, why am I not showing a minus 15 in there? The strike price is 40, so why would I not lose 15 if the stock price goes to 25?
I'm actually not sure.
What's a word that I use with an option? I said you have the right to buy at that price, right? You don't have an obligation. So the stock price is 25, and I say you have the right to buy shares at 40. What's your reaction going to be? I don't need that right. I'm not going to buy it at 40. Guess what? At the $25 strike price, you just walk away saying, it's really not in my best interest to do this. So the reason the cash flow is 0 is because it's an option. You don't exercise the option, you basically lose nothing. Saying, what does that help me with? Remember, the idea of a replicating portfolio is I want to create something that has exactly the same cash flows as the call. So let's play a little game. It's a little bit of algebra, so hang in there. Let's say the stock price is 70, and I want to create a combination of the underlying stock and borrowing that will give me exactly the same cash flows as the option. So for the moment, let's make it abstract. Let's suppose you borrow B dollars and buy D shares of stock. You're saying, what the heck is B and D? Hang in there. I go out and borrow B dollars and buy D shares of stock. If the stock goes to 100, I'm going to get 100 times D. That's the number of shares of stock I bought. I have to repay the borrowing with 11% interest rate. So 100 times D minus the borrowing repaid should be equal to 60. I'm trying to make sure that replicating portfolio has the same cash flows as the call. If the stock goes to 50, 50 times D minus 1.11 times B has to be equal to 10. I know how much of a throwback this is, but remember simultaneous equations? What is it, 7th grade, 8th grade, 9th grade, whenever you did those? You have 2 equations and 2 unknowns. Trust me, if you work long enough and hard enough, the unknowns should become knowns. And in this case, when I solve for D and B, I get D equal to 1, B equal to $36.04. You're saying, what the heck does that even mean? If the stock goes to 70 and I go out and buy 1 share of stock and borrow $36.04, I've created something that looks like, talks like, walks like the option. It's exactly replicating the option. And guess what? That position will cost me $33.96. That's a $1 share at $70, but I borrowed 36.04. I've got to come up with only the difference. My call option, if the stock goes to 70, will be worth $33.96. If I go to 35, I go through the same process, solve for D and B. If I borrow $9.01 and buy 0.4 shares of stock, if the stock goes to 35, I have something that looks exactly like the call. It's going to cost me $4.99. That becomes the value of the call if the stock goes to 35. I move back to today, and already you can see why you got to start at the last stage and work backwards, because the only time you know the cash flows precisely on the call is when it expires. At t equal to 0, if I go through the same process, I come up with the following. If I go out and borrow $21.61 today, And by point, don't even ask me how you buy 0.8278 shares of stock, but if I could, I've created something that looks exactly like the call all the way through the process. That position is going to cost me $19.42. The value of this call option with 2 time periods to expiration and a strike price of 40 is $19.42. This is called the binomial option pricing model. And it comes with a catch, which is at any point in time, your stock can jump to only 1 or 2 points. Can you imagine, if you took at GameStop in the morning today and said, what can the price be at 4 o'clock today? It's not going to be 1 or 2 points, it's 1 of 200,000 points. A point, the shares can go all over the place. I'm restricting to, which means if there's any chance of this model holding, I've got to make time really small. It can't be a day, it can't be an hour. How about a second? Maybe in a second, maybe I can get pretty close. The next second, the price can jump to 1 or 2 points. You're saying, what's wrong with making time a second? Let's say you have a 3-month call option on a stock, and you've decided to use the binomial option pricing model with 1 second time intervals. I'm going to ask you a rhetorical question. Don't give me a precise answer. How many seconds are there in 3 months? A lot of seconds, right? Let's say, but you're a really patient person with a really sharp pencil and you decide to draw a binomial tree of 1 second intervals for 3 months. So you sit there with the tree and you draw tiny little branches and you finish. You know what it's going to look like? It's going to look like a sideways pine tree, this kind of condensed tiny little branches. Hang in there with me. Now let's say you flip the paper over. You now have a pine tree of branches, right? It starts with the top and you go down. Smooth out the outside edges of that pine tree. What do you end up with? If you take a binomial distribution and you smooth out the outside of a binomial distribution, in other words, you make this curve, you have the normal distribution. If you make price changes small, it's called a continuous price distribution. As time gets small, the binomial distribution collapses into what's called the normal distribution. And the binomial option pricing model becomes the Black-Scholes model. Black-Scholes model, of course, the model you hear about in option pricing, it's a special case of the binomial, and it's built on replication arbitrage as well. Fisher, Black, and Marin-Scholes won the Nobel Prize for developing the Black-Scholes model. And in the original version, they came up with an equation. They didn't actually explicitly show the replication, but it's in there. They came up with the value of a call as a function of 5 variables. I'm going to list the 5 out, and I want you to tell me what the missing variable is, because a few pages ago, I listed the variables that affect the value of an option, and I listed 6. Here are the 5 variables in the original Black-Scholes. The value of a call is a function of the S, which is the current value of the underlying asset, K, which is the strike price, T, which is the life of the option, R, which is the riskless rate, and sigma squared. It's not question squared for some reason. Microsoft has gone crazy on me, but sigma squared, which is the variance. S, K, R, T, and sigma. What's the missing variable? Out of the 6 that I listed earlier, what am I missing? Nick?
Can you hear me?
Yeah, I can hear you.
It's the
What's the missing variable? I'll show you the page because that'll make it easier. Those are the 6 variables.
Yeah.
Which one is missing in the Black-Scholes?
it's the dividend yield.
It's dividends.
Yeah.
You know why? The original Black-Scholes was designed to value what are called dividend protected options, which is the strike price also gets adjusted for the dividend. There isn't a single real option out there where this is true. But the originally Black-Scholes, when they developed the model, ran into so many math issues, they decided to make life simpler for themselves. They just ignored dividends. It's what economists do. When you have a problem, act like it's not there, then it goes away. The real world, we have to deal with dividends. I'll give you a dividend adjusted version of the Black-Scholes, but in the original Black-Scholes, here's the sequence. You plug in the numbers S, K, R, T, and sigma. You come up with D1 and D2, which are numbers. You convert the D1 and D2 into areas under the normal distribution. And not level, because usually when you look at statistics books, they give you the height of the distribution. This is the area. So basically, you're measuring the area under a normal distribution. So this is a table you're going to see whenever you use option pricing, where if you give me a value of D, I give you N of D. If you look at N of D, it ranges from 0 to 1. So N of D1 and N of D2 are really areas under the normal distribution. They're like probabilities. And embedded in the black shoals is the replicating portfolio. This N of D1 is called the option delta. It's a number of shares in the underlying stock you will need to buy to replicate the call option. Remember the binomial we came up with that? It's hidden in the black shoals. You're saying, what the heck is KE minus RT? You know what KE minus RT is? It's the present value of the strike price. You're saying, why am I taking the present value of the strike price? Because you don't have to pay it till 2 years from now or 5 years till the option expires. KE minus RT times N of D2 is what you need to borrow. We often plug numbers in the black shoals, we get the option value, we throw the model away, but embedded in the model is very useful information about the replicating portfolio. If you've ever been around option traders, they love to use the Greek alphabet. So option delta, theta, gamma, omega, basically they've taken over the entire alphabet. You know that everything in option trading is about this replicating portfolio? You know what the option theta is? How much the value of an option changes as T changes. What's the option gamma? It's what happens to the delta as the stock price changes. Everything we talk about in option trading is somewhere in this replicating portfolio. If you understand the concept of a replicating portfolio, you're 90% of the way to understanding option pricing better than most people who use option pricing every day. So here's the bottom line. If you have an option that you want to price, if both the underlying asset and the option are traded, it's easier to price it. That's why it's easy to price a listed option on a stock. If you have a real option, like a patent, where neither the underlying asset nor the option is traded, you can use an option pricing model, but it becomes much more difficult to kind of push that model through. The next session when we start, what we're going to start with is bringing in dividends into this model, because we need that to kind of apply this model in some real options. But if you get a chance, review this material, and I'll send you a couple of other things on option pricing, because it's good to start. I won't test you on option pricing on the final, I'll assume you know it, but understanding option pricing is a key step towards using options in valuing real options. Okay, so I'm going to stop, and I will see you on Monday after your third quiz, or so it'll be pretty much set up the same way the second quiz was. Available for multiple hours that day. It's an hour-long quiz, so I'll see you then. Nick, your final question?
Yeah, Professor, it's a quick question. Like I'm gonna have to rewatch everything anyway, because they were fixing my bathroom and I didn't catch like most of the lecture. But I had a quick question. Is like, do you have any examples of any spreadsheets where you value a private business, so that I can like maybe
The only change, and it's the same spreadsheet, but when you go into the traditional spreadsheet, the only number you will change, instead of using a beta, you use a total beta. That's it. Everything else in that spreadsheet, still revenue growth margins. So none of the numerator changes. It's only that discount rate.
I see. Okay. Thank you, Professor.
Welcome.